welcome to Priceline, the pre-budget discussion which focuses on what should be the economic policy issues that should underpin the forthcoming budget. Joining us today are three stalwarts in the realm of Indian economic policy making. Dr. Kirit Parikh, who has been member of the Planning Commission and who authored a report on fuel subsidies. Dr. Abhijit, currently Planning Commission member, who has rendered a long stint at agricultural policies in particular, and Dr. Govinda who is member of the Economic Advisory Council to the Prime Minister and a well-known expert on public finance. Gentlemen, welcome to the show. Well, first up, Dr. Parikh, let me begin with you. Let me throw some numbers at you. Over the past 2.5 years since the Lehman crisis, the net borrowing of the government to finance its fiscal deficit has been 9.2 lakh crore. This is more than the total government borrowing since the past 10 years, that is from 1999 to 2008. So clearly, in the guise of fiscal stimulus, a lot of money has been pumped in. Growth came back to 8.5% plus in 3 or 4 quarters, but fiscal deficit will not come to 3% probably till 2015. So would you go with people who argue that fiscal deficit or the expanded fiscal deficit is itself a huge trigger for inflation, cause of inflation?
I would say that it is a trigger, but it's not a huge trigger. Think of it this way: when the Lehman crisis took place, the government had to stimulate the economy. If it had not stimulated the economy, the economic growth rate would have gone down, government's revenue would have gone down, and perhaps even the fiscal deficit would have been higher than what it turned out to be. So I don't think we can blame the fiscal stimulus that was given after the Lehman crisis to the inflationary expectation. I think inflation has many dimensions of it. First of all, yes, we have food inflation, which is largely a matter of supply in the domestic market of certain commodities like fruits and vegetables, and pulses, which we cannot import easily. And some of the other commodities, the international prices have gone up. You know, currently the international prices are higher than at any time since 1990 of food index price that FO has brought out.
Dr. Rao, what do you think should be the foremost goal of this budget, its first priority?
Definitely fiscal consolidation should be the primary goal of this budget, and that involves both looking at the expenditure and tax sides, because bringing the fiscal deficit down to 4.8% may not be a major task this year, but at least we should set the ball in motion, because as we go along we have a lot of challenges to meet, because over a medium term there has to be an additional adjustment, 3 percentage points to GDP in the case of fiscal deficit up to 2014-15, and then there is also a lot of pressure on increasing expenditures on both health, education and food security. This would mean that there would be an additional expenditure, sort of adjustment to the tune of almost 5% in the medium term. Now, given this situation, I think we need to start setting in motion. Obviously the GST is you cannot introduce this year, but certainly a substantial attempt should be made to increase the tax base of the center by increasing more services into the tax net.
Well, Dr. Rao, you began by saying that 4.8% won't be tough this year. But is not 4.8% going to be tough? There won't be any spectrum bonanza, and the divestment target too may be tough looking at the stock market conditions. This means revenues actually are going to be lower by nearly 1.5 to 2% of the GDP compared to FY11, the current year. On top of it, if you have to achieve a further cut in the deficit to the extent of 0.7%, that is from 5.5 to 4.8, won't that be a tough ask?
No, it is not going to be easy. I didn't say it is easy, but it is, the challenge is not, for example, I have a feeling that this year, because of that one-time money, center would have brought down the fiscal deficit to 5%. Now, obviously it is a one-time money, but then given the fact that you have seen a significant buoyancy in both the direct and indirect taxes, and as the economy recovers, there has been a sharp decline in the tax ratio in the last couple of years at the center, and that has to recover, and there would be some scope for recovery of those taxes. But certainly there are other areas like increased wages in Narega, increased subsidies, which are going to be a major challenge to deal with. But I think with so therefore they have to start working on these. I mean, they in fact there has to be a lot more of rationalization of subsidies and sort of expenditure side, and also returning to the the tax cuts that were made before the tax to meet the global crisis. They need to really start restoring those.
Okay. Well, Dr. Said, let me come to the more hot issue of food prices. To what extent would you attribute that to plain liquidity, and to what extent would you attribute it to supply shortages? My question stems from the fact that actually we are seeing a fairly stiff food inflation across milk, meat, eggs, vegetable, to some extent cereals. They didn't even come down after a fairly excellent harvest.
Yes, we are. I think I personally, and I think most other people in government, were expecting a much lower food inflation at this point in the year. We did see inflation coming down in November, but then we saw it rising very steeply in December. And I'm talking about food inflation. And that happened essentially because of vegetables. It's not even fruits and vegetables, but vegetables. At the end of November, the year-to-year on the vegetable index was negative. At the end of December, it was around 70%. So we got something which happened in December which threw all the food inflation indicators completely off.
Well, one explanation is that for the past 3-4 years, the government has run a fairly successful NREGS program. It has also seen increasing doses of money going through MSP programs into the rural hinterland. All this has created purchasing power, but there has not been a commensurate rise in output, especially of farm products, and that explains part of the inflation. So partly demand-led and to a smaller extent supply-led. Would you buy that bit? And more importantly, what can the budget do towards food inflation to probably control this demand-supply mismatch?
I would agree with the general point, which is that if incomes are growing at a certain rate and food production is not growing at the rate at which the demand as a result of the higher incomes is growing, then you would have inflation. I mean, that's a general statement. Nobody can disagree with it. And I think that's probably true for the last 2 years, because both 2008-9 and 2009-10 were bad agricultural years. What can the budget do? What budgets can do is to, of course, one way of the budget could deal with it is to reduce demand, massively cut down spending. But if you do so, you risk the fact that you're buying. On the one hand, you're trying to reduce the demand, but you might be actually buying more inflation later if a cut budget actually reduces future supplies. I think what the budget should do is recognize that there is an inflationary situation. Some of it might well come from a mismatch between demand and supply. But I think the budget should actually ask itself, first, are we being prudent in a fiscal sense? Second, are we being prudent in the sense of not actually putting in the sort of money in unnecessary things in a way which might actually trigger off higher demand in places where there is a shortage? But most importantly, I think what the budget should do is it must make sure that there is enough money where the supply is short so that the supplies do grow.
do you think that the government, the budget needs to reorient the Bharat Nirman program or its social programs, its plan investments in such a way that waterworks or agricultural productivity or perhaps the beginnings of a new green revolution are ensured by the planned program?
Yes, in general terms, nobody can disagree with that. As it happens, of course, the allocations are fixed. Things are not going to be changed now. It is the last year of the 11th plan. We have a strategy. In some ways it's doing quite well. In some ways it's doing not too well. And you don't have things like second green revolutions, whatever that might mean, happening because of a few 100 or 1,000 crores in 1 year. That's not the way agriculture works. These are long haul issues, and I think we are either